CEO Shri Ashish Chauhan to provide the welcome address to the lecture. Yeah, this works.
Your Excellencies, friends, ladies and gentlemen, good evening. It gives me immense pleasure to welcome all of you to the NSE-IMF seminar on regional economic outlook. This is the 8th event that NSE is organizing jointly with IMF in last 7 years. The overarching agenda for today's event is to discuss the current macroeconomic scenario and outlook for Asia with a special focus on Indian economy in the context of the Regional Economic Outlook publication by the IMF that was launched yesterday. The Indian economy continues to outperform amid a sobering global economy and is expected to be the third largest by 2030. As per the latest estimates by the IMF, India is expected to grow at 6.3% in financial year 24 and 25, with financial year 24 growth getting revised upwards by 20 basis points on the back of a robust expansion in investments and stronger than expected private consumption in the quarter June. It's a testament to the strength of the Indian economy in a slowing global environment. India is better positioned than its emerging peers due to a number of factors. One of the most important drivers of India's economic growth is its strong domestic market. India's population of over 1.4 billion with a growing middle class provides a strong consumer base for goods and services. By 2030, India is projected to have the largest working age group, accounting for approximately 69% of its population, ensuring continued demographic benefits. Healthier balance sheets of corporates and banks, coupled with strong capex pushed by the government, provide a conducive environment for a recovery in private capex. Its strong startup culture will create more jobs, driving growth in the economy. India is expected to remain the office of the world, with several global corporations expanding their presence in India for outsourcing and key back office functions. India is poised to be a global delivery center for emerging technologies in the near future. Rapid digitization has also played a crucial role in driving growth, creating a large online market of consumer across the length and breadth of the country. Last but not the least, supportive government policies and robust infrastructure push have put India on a strong footing to achieve the US dollar 25 trillion GDP mark by 2047. India's equity markets have played a crucial role in efficiently mobilizing savings from investors and channeling them to various industries, thereby acting as a critical agents of capital formation in the country. Capital raised by corporates in last 30 years is nearly rupees 11 trillion. Our market cap to GDP ratio has risen from 44% in 1994, when NSE was set up, to about 115% today. National Stock Exchange has been witnessing an exponential rise in its investor community. We now have an investor base of over 80 million unique investors as of September 2023, more than 60% of which has come in the last 3 years. If we were a country, we would be in top 20 countries and a reasonably rich country to begin with. Our markets today reach 99.8% of PIN codes of India. This is a testament to the rising interest in Indian capital markets, which is a market capitalization of $3.8 trillion, fourth after US, China, including Hong Kong and Japan. Despite its strong economic performance, India faces several challenges too. India needs to strengthen its educational and skills development system to produce more skilled workforce. While India has been a global leader in terms of soft infrastructure, we need to invest heavily in hard infrastructure to support its economic growth. Further effects of climate change could pose a major challenge to the economy. While geopolitics are shifting in India's favor, this comes with a large responsibility in terms of balancing its global partnerships effectively. In this context, getting a wider perspective on the current uncertain global macroeconomic environment and its implications for India will be very helpful. I truly hope you will find this session insightful. Once again, on behalf of NSE, I welcome you all to this conference and thank you all Thank you all for coming here today evening. Welcome.
Thank you, sir. I now invite Dr. Helbling and Dr. Perez on the stage for the presentation. Dr. Helbling is the Deputy Director in the Asia Pacific Department of the International Monetary Fund and has been associated with the organization since 1994. Previously, he was the Mission Chief for Mexico, Indonesia, and the Philippines. His recent research has focused on commodity price dynamics and global economic conditions, global oil markets, international economy policy issues, international business cycle linkages, and economic history. He has a doctorate in international economics from the Graduate Institute of International Studies in Geneva, Switzerland. Welcome, sir. Dr. Perez is the Division Chief of Regional Studies in the Asia and Pacific Department at the IMF and oversees APD's flagship Regional Economic Outlook publication. He joined the economist program at the IMF in 2001 after completing his PhD in economics at Oxford University as a British Chevening Scholar. He has published academic journal papers on a wide range of topics, including inclusive growth, monetary policy, inflation, bond markets, banking and finance, macroeconomic models for emerging markets, and co-edited books on ASEAN and sub-Saharan African countries. Over to both of you, sir.
This is mine. Thank you and good afternoon to all of you. Thank you for coming to the seminar. We are very grateful to NSE for hosting this event for the presentation of our annual Regional Economic Outlook. It's a great honor to be here in the region. I will split the presentation between Jay and I. I will focus on the broad outlook themes with a special focus on inflation and monetary policy. Jay will then focus on another big theme, both in the outlook and then in terms of our analytical chapter, China and geoeconomic fragmentation or de-risking. Let me start right away, go into the outlook. Sorry, I need to see a bit. The general backdrop for our regional economic outlook is a world economic outlook that is relatively sober. You may recall, you may have seen the headline of our chief economist that the global economy is limping along this year in 23 and 24 after several years with a series of large shocks that are still affecting the global economy. Asia is a relatively bright spot in this context. India, even more so, as it has already been mentioned. So we see growth in Asia increasing to 4.6% this year and then moderating to 4.2% next year. Relatively speaking, as forecasters, we always look at the revisions. So for this year, there's no revision. And for next year, there is a relatively small downward revision in the regional growth by 0.2 percentage points. Most of that is due to China. Starting with Asia's advanced economies, we would distinguish two groups. One is in particular are the open, more trade and merchandise oriented economies, Japan and Korea in particular. Japan is on its own track. This year, we have revised growth up by 0.7 percentage points to 2%, and then it is slowing. What is surprising, what's behind the surprises? Two factors: very robust domestic consumption and an export recovery in the first half of the year, mostly on account of supply chain normalization. Domestic demand is supported by very accommodative fiscal and monetary policy. Korea, in contrast, has been affected more
by weak global demand. Its export recovery predates that of Japan, and Korea has been hit in particularly has been a more extensive and prolonged tech downturn. This is a theme I will come back to. Next year, we see growth increasing, though, partly on a recovery in the tech cycle, then a stabilization of the housing market after a downturn in 2022 and earlier this year, and also a nascent recovery in tourism from China. Then turning to Australia and New Zealand, where on the domestic side, the monetary policy tightening has really hit the domestic demand in these economies, while actually on the external side, both of them being commodity exporters, they have seen robust external demand. So in both economies, we see them slowing next year, mostly on account of domestic demand. Let me then turn to Asia's emerging markets, where overall we see an increasing growth from 4.5% to 5.2%, and then next year a moderation to 4.8%. The elephant in the room, so to speak, in Asia's outlook this year is, of course, China. I will defer to Jay to discuss developments in China. But what matters for the regional aggregate is the rebound after the COVID year last year. So we have revised China just moderately from 5.2% growth to 5% this year, and then a moderation to 4.2%. Overall, we see China on track for the 5%, and that is driving much, but not all, of the uptick. Let me wait with India just for a minute and turn then to the ASEAN economies, the very open economies, which in general have been hit hard also by the slowing in external demand this year, the slowing of goods, the demand for goods and merchandise. And some of the economies have also seen a cooling in domestic demand after a very strong COVID rebound in last year, and now also some monetary policy tightening. For the Pacific Island economies, they have seen some recovery this year after almost complete lockdowns and virtually no tourist arrivals in most of them. The economic outlook remains difficult, but some of them will see actually further rebound in tourism. Okay. I had initially also a slide on India's economy, so I see that slide is missing. Let me just go back then. India is the one economy that stands out with very robust domestic demand. So in fact, unlike for the rest of the Asian emerging market and developing economies where we have revised growth down, we have revised growth up for this year by 0.4 percentage points relative to the April economic outlook. So growth overall 6.3% and 6.3% again next year. Domestic demand is robust, driven in particular by a public investment program that has had important spillovers to private investment. And now, after several quarters of robust growth, is now also broadened to the economy overall. Let me then come to a very important theme for the regional economic outlook overall, and that's the external outlook, the prospects for net exports. Here we have two contrasting factors at work. On the one hand, if we look at the global economy at the moment, we have revised down almost everywhere. The one economy where we have revised upward, it's the US economy. And you can see that in the left-hand side chart, where we look at the revisions to growth, both in our April World Economic Outlook. These are the blue parts of the bars, and the red bars are the revisions since our July World Economic Outlook. And what you can see is upward revisions both between April and July, and then again July and August. The US economy has seen a very strong services rebound, and despite quite remarkable monetary policy tightening over the past few months, we have seen the resilience. Overall, there is the theme that the risks for the US economy, which have then also mapped to some extent in the global economy, more balanced growth and prospects for a soft landing in the economy. That is an economy that will see inflation coming down without very large increases in unemployment or declines in output relative to trend. In contrast, we have revised down growth in China. In this round of the World Economic Outlook, it's relatively speaking a small downward revision, but still for Asia it matters given the very tight and large trade linkages. Taking together, and I think that's what you also then can see comparing both 23 and 24, is that we have strong upward revisions both for the US and relatively small downward revisions for China. This would translate then in a strong positive impetus for Asia through export channels usually. And if you look at the middle chart, this is the usual impact that you would see. The net effect is shown in the black line in the middle chart, and so you would see a strong impetus. Now, this time, though, what we also see is what we call the demand rotation from goods to services. I should emphasize this is a temporary or a very episodical force that is at work after there was a demand rotation from services to goods to COVID, and now this rotation is unwound. But it is very important for Asia, which is a large net exporter of merchandise, net exporters, which typically drive growth. So then if you take this factor into account, the growth revisions plus the changes in the composition in demand, you see then the black line in the right-hand side chart, which is considerably lower. The bottom line, so this year, despite a resilient and a more upbeat outlook for the United States, a relatively less positive outlook, net export outlook for Asia in the near term. This is compounded or relates also to the tech cycle, which has been deeper and more prolonged than expected. Initially, we expected a rebound already by the middle of this year. We now expect a more gradual rebound in the second half this year, and then in 2024. That, for example, explains the outlook for Korea, where we see a noticeable increase in growth for next year. Let me then turn to domestic demand. Obviously, there has been some slowing this year. Much of it was this moderation or a normalization after the COVID rebound in Asia, but there is also monetary policy tightening. One factor or one observation in this regard is that if you look at the components of demand, that it's particularly investment that has slowed earlier this year throughout the region. We would notice there are two factors. One is that we have seen economic scarring or in investment more so than in consumption since the onset of COVID. So if you look at pre-COVID investment forecasts, you see relatively large, lower trajectories for the region, particularly emerging Asia as a whole, emerging and developing Asia as a whole. If I have the right number in mind, it's by 2024 relative to pre-COVID forecast, the investment level is 9% below. So you have, in that sense, a double whammy, legacies of COVID, and now the monetary policy tightening, which has affected Asian emerging market economies relatively more. And as mentioned, corporate leverage in Asia, both advanced and emerging is relatively high, so higher debt service cost affect the outlook. I've talked about the India. Let me then turn to a number of risks. One risk concerns global financial conditions, and if you look at the left-hand side chart, what you can see is with the monetary policy tightening, financial conditions have tightened in advanced Asia, and that is the blue line. So relative to normal conditions, which is zero in the way this index is constructed, conditions are tighter as expected. If you then look at emerging Asia, excluding China, you see that the red line is below zero. And despite monetary policy tightening throughout emerging Asia relative to, say, 2021, when the monetary policy easing implemented during COVID was still in place, financial conditions have remained relatively easy or accommodative. And what's noticeable in this part, aspect, is that longer term local currency sovereign yields are still relatively low. They have, in some cases, increased, say, relative to 2021. But given the increases in longer term rates we have seen in the United States, other advanced economies, they have not increased that much, and that's remarkable. If we look at previous episodes of monetary tightening, and also considering the usually very strong interest rate linkages with globalized and international financial linkages. So we are concerned about two risks. One is, and some of that risk has been materializing over the past few weeks, is increased longer-term yields in the United States, which, as the middle chart shows, clearly have negative growth effects. If you then also look at Asian, especially emerging and developing economies, where financial conditions are relatively accommodative because of longer-term yields, if there were some normalization, if there were some increase in the term premium more in line with normalization, it would have a negative growth effect. You see that both by the shift in the curves on the right chart. On the left-hand side, you see the impact on median growth and over different horizons, and then at the right side, you see the impact, the growth at risk impact, that is the lower tails of the distribution relative to the median, also over the horizon. That's one risk we remain concerned about. Related also, as it would eventually translate into financial conditions, are still upside risks to inflation. For all economies in the region, they are related partly to commodity prices. And as you can see, if you look at the impact of shocks to commodity prices in the middle chart, you see that in particular oil price surprises have a large impact on core inflation in Asia. In the middle, the red bars show the impact on emerging market economies. So if you look at just the middle impact of crude oil, it would have a large impact. Relative to where we are in the WIO, we had an oil price assumption of $86 per barrel. We are now at slightly over 90, around 80. So already some surprise from there. With recent developments in the Middle East, there are further upside surprises. In advanced economies, there are also some upside surprise potential from still relatively tight labor markets through advanced Asia. Both Australia and New Zealand, but also Korea, have unemployment still at record lows. We have in our World Economic Outlook then an analytical chapter on the inflation experience in Asia. the inflation experience is remarkable for a number of reasons. One is that inflation in Asia has started to rise later than it has elsewhere in the most recent episode. Inflation also, in general, has risen by less. And then Asia also in general has seen stronger disinflation than the rest in the world over the past 12 months or so. In fact, if you look at the regional economic outlook, one point we highlight is that disinflation has been stronger and that inflation is expected to be back at target in most economies already in 2024, whereas in the rest of the world, it's more 2025. So what this means, translates to, is probably relatively lower upside risk or lower challenges to monetary policy, which is a more comfortable spot. But then also still the influence, the region also faces the issue of monetary policy divergence in the sense that perhaps domestically there is less need to increase further, potentially, but still there would be spillbacks or spillovers if the rest of the world faced a bigger inflation issue than expected. But the chapter itself focuses more on understanding why the inflation dynamics in Asia has been different. What are the main drivers behind that? I should also, before going into that, emphasize that there's still considerably heterogeneity in the region, in the inflation experience. I would like in particular to highlight that both Japan and China have seen very different inflation dynamics. In Japan, we have seen much less disinflation. Inflation is still running substantially above the BOJ's target for the moment, whereas in China, of course, inflation has been low, substantially below average or desirable levels. Let me then quickly just highlight a few facts about inflation. If you look at the core, the contributions to core inflation, to inflation overall, you can see that in Asia, there has been a lot of relatively more contribution compared to other countries, especially the advanced economies, from food, energy, and imported inflation. So the external price shocks were very significant, but in general, they were not as strong as seen elsewhere. Another factor that is very important is a very different pandemic dynamics. But let me take one step back. If you look at the impact of external price shocks in Asia, one relatively important factor why the external price shocks, which were translated into import prices and affected the balance of payments, were administered prices. So typically, food prices in particular had less of an impact on headline inflation and also on core inflation. While there are some second round effects from headline increase in food prices and energy prices on core inflation, they have been relatively smaller as a result of more administered prices in the areas of commodity prices. If we then look at the pandemic, its dynamics has been different from two angles. One was just the health policy response. So on average, the lockdowns and the health policy response in Asia were in effect relatively longer. So Asia has rebounded relatively later, therefore, than the rest of the world. It has then also rebounded at the time when there was already some supply chain normalization compared to the rebound in the rest of the world. Then second, the other side of the pandemic coin was the policy support throughout Asia in general was relatively less generous. In particular, there was less demand stimulus once COVID was the worst impact of COVID on the health impact was starting to decline. So as a result, the combination of the two factors, and it's important to see that COVID both had demand and supply effects. In the beginning, it had some supply effects on some sectors, mostly those affected, but then it also had demand effects because while some sectors were closed, other sectors saw increased demand. The story is, of course, known in the US, where there was shifts from services to goods. So what this has meant for Asia, that these dynamics was relatively milder than elsewhere in the world, and that has also contributed to the why Asia has seen less of a spike in inflation. And then some of these factors were starting to be unwound, both regionally but also globally. We could see faster disinflation in Asia. Then the question that was frequently raised with us when we discussed the inflation outlook and what this meant for monetary policy was, did central banks have to respond to the inflation surge, since some of that inflation research was supply driven? And the short answer here is yes. So we would emphasize that monetary policymakers in the region responded appropriately to the challenges, first by easing monetary policy during the worst days of COVID, when economic activity was plummeting, unemployment was rising, inflation pressures were waning, and then also by tightening policies once the situation was changing, imported inflation started rising. And I would then point to our analytical work, which you can see in more detail in the Regional Economic Outlook in Chapter 2. Two analytical exercises. One was a decomposition of inflation dynamics into supply and demand elements. What I just mentioned, the COVID shock, the health responses, policy responses, the impact on COVID had a complex supply and had complex demand and supply impact. So an econometric exercise then that decomposed inflation dynamics here at the level of the personal consumption of the GDP deflators by sectors. If you then look and do this decomposition, you can see that also in Asia, there was a substantial demand element to the rise in inflation in 21 and 22, which then we would say argued for a normalization and then tightening of monetary policy after the easing. The second element was that if you look at inflation expectations, they also started rising. In the beginning, it was mostly near-term inflation expectation, but then from experience, we also know that there is the scope for spillovers into longer-term and medium-term inflation expectations, which is what matters for price stability and monetary policy credibility. And we could see these increases, in particular also if you look at the dotted red line, which you see is the comparison with the rest of the world. So in similar inflation dynamics in Asia with the rest of the world, but then I think unlike the rest of the world, Asia at the moment faces a relatively less acute monetary policy challenge domestically. You can see both in advanced Asia, that's the blue line, and in emerging Asia, that's the red line. You see relatively more disinflation also embedded in inflation expectations. So overall, monetary policy response appropriate, also against the backdrop of the inflation dynamics. Then coming back to one theme I discussed earlier, financial conditions. So in terms of nominal rates, Asia has been similar to the rest of the world, relatively sharp increases in policy rates, both in advanced and in emerging Asia. if you compare that to previous cycles, these are the gray lines, you see that the thick red lines see a steeper increase in policy rates relative to previous cycles. But then if you look at real policy rates on an expected ex-ante basis, which is what really matters for the monetary policy stance, you see that compared to previous cycles, still there was relatively less monetary policy tightening. And I think the main reason for that was just the inflation surge, and which then also led to revisions in inflation forecasts and inflation expectations. And then if you look at financial conditions, it translated into a relatively less tightening in financial conditions. Again, if you compare the thick red lines compared to the gray lines. What does it mean for monetary policy is that, relatively speaking, if monetary policy tightening doesn't translate into tighter financial conditions more generally, then there will be less of an impact both on output but also in inflation. So for this reason, let me come to my last slide. We still would warn against the premature easing of inflation in Asia, given that still policy is not that tight yet. And then we come with the broad monetary policy recommendation: maintain the current, still relatively restrictive monetary policy stance until inflation is reliably on a path back to target. And that's an unexpected, forward-looking sense, of course, not as inflation for today. And then second, with higher interest rates, there's still financial stability risks. So we say, given that conditions are orderly, relatively speaking, use macroprudential policies to address the financial stability risks, reduce vulnerabilities, and address acute stability issues in pockets of the financial system. We also say, be prepared for the lagged effects of higher interest rates, and their strengthened bank resolution and insolvency frameworks were needed, because we would still expect that asset quality risks will continue to increase. And then finally, look at other policies, in particular, increase fiscal buffers to again be ready for potentially large shocks and have the space to respond to these shocks with all policies available. Thank you.
So thank you, Thomas, and thank you for everybody here. So Thomas outlined our regional economic outlook, the risk we see, as well as a bit of a deep dive on inflation and monetary policy, because that was one of also our analytical chapters. We have another second analytical chapter on China outlook, medium-term outlook, and de-risking of fragmentation, whatever you want to call it. I'm going to go into more detail of that chapter, but I'm going to start a bit with the outlook for China as well. So near term, everybody's talking about China. Thomas didn't cover China so much because I was going to do that. So real estate sector, everybody talks about the real estate sector in China. You can see on the left side chart there that, sales are down, starts are down. So real estate investment is very negative. That's a big drag on the Chinese economy in the short term. There's also the discussion about pressures in the developers, whether you look at the bond spreads or the equities of some of the biggest developers, and even some other, obviously the smaller developers, the more troubled developers have taken a bigger hit, but basically the sector across the board is facing quite a lot of pressure. So that's what you hear a lot, and that's definitely a big drag on the economy, and this is why we emphasize the need for a comprehensive solution in the real estate sector in the short term for China to have a more sustainable level of growth. But the good news is also that if you look at the overall picture in China, even though the real estate sector is a big drag, if you look at with the reopening, you had services sector getting a boost, like we saw everywhere in the world. Manufacturing, not so much, but it is now gone to positive territory, but it's still fairly anemic. But that's also partly related to the global demand being quite weak. So overall, as Thomas mentioned, we have revised our growth down for China from 5.2 to 5 this year to 4.2 next year. But you can see the composition. The composition matters, right? And we see that because of the real estate for this year and next, the downward revisions to growth mainly coming from reductions in or revisions in investment. So if China's investment is lower, that means countries, commodity exporters could be more hit. So it depends a bit how the China slowdown will affect you, especially if you're exposed more to China's investment. So we've done a lot of work. I mean, a lot of people ask us, how does China affect the rest of the world? The left-hand side chart shows you how we see China GDP shocks or particular investment shocks or shocks to real estate, how they affect it. On average, if China's GDP or overall activity goes down by 1 percentage point, we think a global GDP goes down by 0.3. So a beta of about 0.3 is the rule of thumb, probably over like a 2-3 year horizon. But there is a bit of different dynamic. As I said, because the investment slowdown is what's driving current drag in China, that will have a slightly different effect. Investment is more volatile, so the beta is low, but if you look, investment is moving a lot, so the impact could be larger depending on your economy. And on the right side, you want to look at not gross exposure, but you want to look at what is my exposure in value-added terms to China. And on the right-hand side, you can see that some countries' exposure to China's investment is much higher than others, right? So like, Cambodia is quite exposed. So you can see it depends on your exposure of your economy in value-added terms to China's consumption and investment. So in that sense, you can really kind of figure out how the China slowdown could affect you. But the short term is quite well known. I think what I'm going to focus a bit more on is the medium term. We have revised our medium term outlook in China quite substantially in the last Article 4, and probably it's less kind of discussed in common, in the public, which is that we have a forecast of China's medium term growth being 3.4% in 2028. A gradual, and why do we think that it is? In the left-hand side chart, it shows you that, China has been overperforming. It's level up, countries normally catch up when they're growing up, right? When they're growing, right? And China has been overperforming from where its per capita income is for the last 3 decades. But we are expecting China's overperformance to go down. So China's growth is going to go, it's slowing down, as I said, to about 3.5% by 2028. And on the middle chart, it shows you that this overperformance over the last 2 or 3 decades of China has meant that Asia, because it's more integrated with China, particularly through global value chains, has benefiting about 0.3, 0.4 to 0.5% of GDP just because of China. Just being better integrated with China compared to the rest of the world meant that we also benefited largely by China's overperformance. So that overperformance is going away. What does that mean? I kind of showed you in the short term what it could mean, but in the long term, I want to focus on 2 aspects. Our baseline forecast doesn't actually have a de-risking scenario or the China plus 1 scenario. So China's economy is slowing down. There is added downside risk that with de-risking or the China plus 1 strategy, you could have slower growth in China. But of course, also if, as I showed you, if China does more reforms, it could reignite convergence process and grow faster as well. So I'm going to discuss both a downside scenario and upside scenario. Particularly, I think the downside scenario, which is already happening in a sense. This scenario is a de-risking scenario. And we kind of think it's somewhat happening already. This is not the kind of sharp fragmentation scenarios we've discussed the last 1 year. It's not a world dividing into two blocks and nobody trading with each other. It's a de-risking scenario where we think it's kind of already happening. With 2 dimensions. One is friendshoring. So think of the world as OECD and China, right? The OECD economies, which is a large part of the world, doesn't take so much inputs from China anymore, but takes inputs from other parts of the world. So that's what we call friendshoring, right? So OECD economies start taking their, intermediate inputs are very important, right? They take their inputs and they're trading more with, not with China, but with other countries. That's friendshoring. Reshoring is that OECD kind of views us more domestic. You've had the CHIPS Act, European, there's been a number of kind of policies recently where you're trying to encourage more domestic inputs and domestic production rather than importing. So these two scenarios can have very particular impacts on the global economy and your own economies. And it's roughly this scenario I'm going to show you the impact of is really kind of dialing back the kind of integration we've had to the last 20 years. So in a sense, dialing back our relationship to a certain degree to 2000s pre-China's WTO accession. So what would happen in those type of scenarios? And just to say, as I said, there's already signs of it. On the left-hand side chart, this greenfield FDI investment, it shows you that already there is this somewhat early signs of some moving away. These based on US firms, and it's a greenfield investments only. So it captures really what's happening right now. You can see this light, movement away from China into some other countries, including India, which is starting to benefit. But the important on the right-hand side, this is based on model simulation from a trade model and also a macro model. We look at the scenarios. First, I'm going to focus on friendshoring, which is the blue lines. Friendshoring, so remember, friendshoring is OECD starts not wanting so many inputs from China, but gets it from the rest, right? And these based on current competitive advantages and current trading patterns. So these are long-term models. So think of it like a 15-year, 20-year impact. We also model the transition, but I'm only showing the long-term impacts here. So you can see that China has a big, even in the friendshoring, which is the blue, China has a big loss. Why? Because, we're not getting stuff from China anymore, right? But other countries are also affected, right? Korea is largely affected. Korea in a particular case because Korea is also a part of OECD. That's why Korea is affected double whammy because it's a part of OECD, so it buys less from China, but also China buys less from Korea. But also because Korea is very integrated in the global supply chains, it loses a lot. These are modeled with global value chains as well, right? US loses, but say 1%, while China loses nearly 6% in the friendshoring scenario. You see other countries, India, Indonesia, it's kind of a wash. What I said, these are in the long term, right? In the short term, it could be that a few countries benefit. But the point here is that even in the friendshoring scenario, because the OECD and China is worse off, in the long term, even if you might benefit a bit in the short term through friendshoring, in the long term, you're likely to lose unless you take policies which attract and have a higher productivity growth. The reshoring is very clear, right? In the reshoring scenario, if the OECD and China basically focus more on domestic production, which is what you're seeing to a degree, everyone loses. And the impacts are quite large, right? So I think that's one of the things. And of course, if you're more integrated like Korea, you're going to be affected more. But those impacts are quite large. Global GDP would be about 4.5% lower in the long term than what would be currently projected on a reshoring exercise. So I think we want to emphasize is that what should we do about it? How should we think about this? Obviously, you saw the losses to China could be quite large. And also China is already slowing, as I showed you in our projection based on current trends of demographics and productivity growth, which is quite anemic in China. So what could China do? China should pursue a comprehensive set of reforms, not only the short-term cyclical on the real estate, but a comprehensive set of reforms to reignite its convergence process, particularly maybe state enterprises. Productivity is much lower than the private sector, trying to bring them closer to the productivity of the private sector through more competition and neutrality is important. So those kind of reforms to bring China could really ignite China's growth rate back up. As you can see on the right-hand side of it, we have an exercise of how China really could grow faster with a comprehensive set of reforms. I think one important point here is that for the rest of Asia, I think we should not think about it as we can be innocent bystanders and benefit from friendshoring and we are all okay. I think the point here we want to make is that from our simulations, in the short term, there may be some gains, but in the long term, because OECD and China probably in any kind of scenario of friendshoring, reshoring are going to be negatively affected, that's going to be bad for us as well because we are an integrated world. So if we want to benefit, we need to do more reforms to be able to attract new sectors, have a higher productivity growth, and then only can we really benefit. I think that's the important point. For the global economy, as you said, as you saw, it's a pretty bad scenario, particularly reshoring. So, supporting the multilateral system, trying to work out your problems, and keep an open trading system is the best. Thank you.
Thank you so much, sir, for such an insightful presentation. Now, I would request our esteemed panelists to take the discussion forward. I request Dr. Srinivasan, Dr. Nitsure, Shri Sabnavis, Dr. Chinoy, and Dr. Patnaik to please join us on the stage. Let me quickly introduce the panelists to all of you. Dr. Krishna Srinivasan is the Director of Asia and Pacific Department at IMF. He holds more than 27 years of experience working with the fund. Prior to joining the IMF, he has worked with Indiana Purdue University, World Bank, Center for Policy Research and Planning Commission, New Delhi. His wide research ranges on Asia, Latin America, and the Caribbean, along with climate and economic development issues. Dr. Srinivasan holds a PhD honors in economics from Indiana University, a master's in economics from Delhi School of Economics. Welcome, sir. Shri Madan Sabnavis is a chief economist at Bank of Baroda. He has been a corporate economist since 1987 and has worked in the fields of development banking, commercial banking, commodity markets, and credit ratings. He has over 2,500 articles and 4 books to his publications. He has served on various committees, including SEBI CDAC and RAC, IIBEF's RAC Committee, and Education Committee. He has been the chairman and co-chairman of committees of BCCI and IMC. He's a postgraduate in economics from Delhi School of Economics. Welcome, sir. Dr. Rupa Nitsure has been working as the Group Chief Economist of L&T Finance Holding Limited since 2015. Prior to joining L&T, she worked as a Chief Economist at Bank of Baroda. She has also worked as a senior economist with ICICI and ICICI Bank, and the key areas of specialization are macroeconomics and financial intermediation. She has served in various committees appointed by the policymakers and published several articles in the field of policy-oriented research. Dr. Nitsure holds MA Economics, MPhil Economics, and PhD Economics, PhD Macroeconometric Modeling from Gokhale Institute of Politics and Economics. Welcome, ma'am. Dr. Sajid Chinoy is the Managing Director and Chief India Economist at JP Morgan. He is currently serving a second term as part-term member of the Economic Advisory Council to the Prime Minister. He previously served on the Advisory Council to India's 15th Finance Commission and was a member of the Expert Committee to revise and strengthen the monetary policy framework set by the RBI in 2013. He has also served on other RBI committees and in 2016 served as a consultant to the FRBM Review Committee. Dr. Chinoy has previously worked at the IMF. He received his PhD at Stanford University. Welcome, sir. Dr. Patnaik is Chief Economist at National Stock Exchange. He has over 2 decades of experience in the Indian capital markets, academic research, credit research and macro and sector strategy, quantitative finance, and consumer banking. In his last assignment prior to joining NSE, he was a chief strategist and head of research for India and Japan-based Mitsubishi Bank. Dr. Patnaik has received his PhD from IGIDR and is an MSc in Stats and a BSc in Mathematics, both from University of Madras. Now I request Sir Dr. Patnaik to take the discussion forward.
I also request Krishna to give me.
Yeah.
We're beginning a little late, but it gives me again great pleasure to start this panel discussion. Going through the last slides of the previous presentation by Jay, where we saw how even if you do friendshoring or you do reshoring, ultimately everybody ends up losing. I was reminded of Neville Chamberlain's quote about, in a war, there are no winners. So when you move away from free trade, actually, whichever way you go, whatever direction you go, you end up losing. I think that's some kind of direction we are seeing here from the current wave of protectionism that's coming up in the global economy. But I'm sure a much better description or a much better response to the presentation could be given by my friend Sajid Chinoy. So I would invite the panel to give their thoughts first on the presentation per se, but I would begin with you, Sajid. You do have a presentation.
I actually had a few slides, so I'm just going to complement what was said. But let me just start by congratulating Krishna and Jay and Thomas for a fantastic Rio. I think it touches on all the key issues, so really enjoyed reading it. This was just meant to be slightly provocative because this is something that we've just been writing at JP Morgan. And the question is that, is Asia sitting on the horns of a policy conundrum at the moment? I think one of the most revealing charts in the Rio was the one about output losses in Asia, right? The fact that everybody's so focused on growth, but if you step back and take a look at levels, to varying degrees, parts of Asia are anywhere from 8 to 10 to 12% below their pre-pandemic path. And to the extent that that's the case, that perhaps influenced the way inflation played out, because there was more slack in these economies. And that's perhaps one of the reasons why inflation didn't pick up as sharply as the rest of the world. And the question is that, does that influence the way policymakers respond to this growth inflation trade-off? So what I'm going to contend is that monetary policy is perhaps confronting a trilemma. In Asia, fiscal policy is forced to tighten given where debt is and what happens with debt sustainability. And the risk, forward-looking risk, and I think Thomas alluded to this, is that will policy forced to be more pro-cyclical and be more tighter given where external financial conditions are vis-a-vis domestic growth inflation dynamics, I guess is the question. So we've always been using this pre-pandemic path even to gauge India's recovery. And I guess the trilemma here, is the question is most of these Asian economies are very open. You would like to respond to domestic growth inflation dynamics and therefore have independent monetary policy. But there's been this fear of floating in Asia for a very long time. And you can see that if I just look at how exchange rates have moved, say from the middle of July to now, when the dollar began to strengthen, this is all in most emerging markets. You will notice that Asia is at the top. We've got the CNY, you've got the rupee, you've got the peso, you've got the baht, the Korean won. And so policymakers have consciously tried to reduce the quantum of depreciation for whatever reason. Maybe there's financial stability concerns, maybe there are worries about imported inflation, but in so doing, used up a fair quantum of reserves. So this is the reserve accumulation. I'm just looking at 2020 end to 2023 to get a sense of where that is. Now, none of this is to suggest that there is no problem with reserve adequacy. Most of these Asian economies have plenty of reserves. But I guess the question is that if you're reluctant to raise interest rates and you're using reserves, to mitigate pressures on the exchange rate, there's going to come a point in time where this policy may not be sustainable if the global financial conditions remain tight for very long. So far, we've been saying that inflation has moved, is beginning to come down. Policy rates have not been particularly elevated. And for what it's worth, at JP Morgan, our economists in the region think that by the second quarter of 2024, inflation in most countries will be back to target or within the range. So the question is that ordinarily, if inflation is back to target by the middle of next year, and you're 8 to 10% below your pre-pandemic path, should policy turn more supportive at some point next year? And the question is that that's going to be prevented by the fact that interest rate differentials with the US have now reduced to record levels. So this is just a weighted average EMation rate. And this is now negative, right, compared to US yields. And you can look at different countries over there and look at the policy rate differential that existed in the decade of the 2000s and where it is now. And in virtually every country, it's dramatically below. And the only reason I'm bringing this up is this is adding tension to monetary policy. The fact that interest rates are so narrow, US yields keep going up, there are pressures on the currency to depreciate as the dollar continues to strengthen. You've already run down some amount of reserves, is raising tensions. We're seeing this by the fact that many central banks in the region have been undertaking stealth hikes, right? So whether you look at what's happening in Malaysia or Indonesia, central banks are tightening liquidity. And even though policy rates haven't moved up, overnight money market rates or 10-year bond yields are moving up to try and mirror what's happening externally. In India's case, for example, as we all know, the central bank has consciously kept liquidity tight enough, and I think rightly so, to ensure that your call money rate is above the policy rate. So I guess the question is going to be that that even as inflation comes down, it'll be very hard for these central banks to cut rates. BI, for example, I think hiked today. Nobody expected them to hike, and they hiked because they've been using up a fair amount of reserves. So I guess the question really is that will monetary policy actually be forced because of external conditions to remain unduly elevated going forward? If you look at real interest rates, our forecast is that this will go up towards 2 percentage points next year because you can't cut policy rates. Inflation, we think, is coming down, and that's going to be much above. So the trilemma will force central banks to keep rates effectively, de facto rates, higher than domestic growth inflation dynamics. Fiscal policy, as has been pointed out in the Rio, is going to struggle to be supportive, given where this is from the fiscal monitor, that debt levels even 5 years from now are going to be high or elevated. So there's no space for fiscal policy. And so I guess my last chart is, will policy be forced to be more pro-cyclical than domestic growth inflation dynamics would warrant because of what's happening globally, because of the trilemma, because of public debt? And I guess the policy implications are, should central banks allow the exchange rate to be more of a shock absorber and in a way break that trilemma, let the exchange rate do the external balance work, let monetary policy do internal balance work? Given where debt is, we don't, in India's case, for example, want infrastructure spending to be cut. We know we need more health spending, more education spending. And so do we need more tax revenue? And I guess the last part, which is almost self-evident, is given that you're 7, 8, 10% below your pre-pandemic path, isn't there a very urgent imperative to do more structural reform to make up this gap? Because fiscal monetary can only tinker with the cyclical stuff. But if 4 years from now, we're still 10% below our pre-pandemic path, it suggests that reform needs to put up potential growth. So maybe I'm stating the obvious, but thanks for giving me the time.
Thank you. Thanks a lot, Sajid. Thanks a lot. I think we have a clear segue to the rest of the panel about the implications of such high real interest rates. Sajid pointed out that we are ending up at about 200 basis points of real interest rates in the economy. Given where we would like real interest rates to be in the economy today, let's say for India, what should be the policy imperative? Rupa, we may start with you.
Yeah, thanks. First of all, thank you for a very insightful presentation. A lot is already said by Sajid, but, as you said, this wave of protectionism, on the one hand, it's impacting Asian countries from the trade side. But on the other hand, the way global headwinds are evolving, somewhere I feel that our policymakers are not today in a position to respond to our domestic challenges fully. Because point is that the three factors, just to summarize from Jay's presentation and what Sajid said, that are weighing today on us is high global crude oil prices. That is because of all these OPEC plus supply cuts, inventory depletion, etc. Secondly, historically high level of dollar index, US dollar index. And thirdly, this narrowing of interest rate differentials. And this whole higher for longer thrust of global monetary policy makers, it will not allow us to respond to our domestic growth inflation dynamics in an effective fashion. And I think more than anything, for emerging markets in Asia, for the policy makers, exchange rate will be a decisive factor and will have more influence on the policy mix than anything else.
So they have sufficient FX reserves. Or beyond that, they let the exchange rate take the shocks for.
Yes, but point is that see, we have our own domestic challenges in terms of subpar monsoon. We have started seeing early signs of weaknesses in rural demand. We all know that this advantage of base effect will not be there for the second half. So we are going to have some kind of a growth slowdown in the second half. Ahead of elections, there will be constraints on government to give the same push to the capex spending. We have seen it. I mean, from history, it's quite obvious. Given that, ideally everybody in the bond market was expecting real interest rates and cost of borrowing to come down and take the economy on a sustainable growth path. But now these external headwinds, they are kind of influencing the policy space to a great extent, and we are not in a position to effectively respond to our growth inflation challenges.
I think well summarized by Sajid, and the implications put out by Rupa. I have my next question for Krishna. Thank you, Rupa. We mentioned in the VO that global growth is holding better than anticipated by many. What do you think might change? What are the factors that might play against this? So, you have geopolitical tensions, energy, food price shocks, property sector crisis, which also came about in the presentation by Thomas. What are the long-term effects? And if you could also speak a little bit about this point that Rupa spoke about persistent dollars tightening. And lastly, of course, how long can we remain decoupled in India? That is.
Thanks. Again, as Thomas mentioned in his presentation, even though we see recovery happening, it's weak, it's uneven, and there's a lot of divergence across the world, and that's true even in Asia. So even as we revised, the numbers for Asia look good at 4.6%. Within Asia, there's a lot of divergence. So we have revised our growth forecast for China down, for India up, for Japan up, but for ASEAN down. So within that context, I think what is important is there are many risks which we highlight. One, of course, Sajid talked about inflation coming down. I think there's still upside risk to inflation, which we should not discount. With what's happening, the conflict, we've seen shock after shock. So it's clear inflation's coming down in Asia more so than anywhere else. And so that gives us some satisfaction, but it's not yet time to call victory. Central banks have to be on the guard, keep a monetary policy tightening thing, which is what you saw in Bank of Indonesia. I think they recognize the risks from that. The other risk which you asked me about is China. I think in China, we have the issue of the real estate sector. It is slowing down the economy, but more importantly, they don't have a strategy to address the real estate problem right now. So on top of the fact that they have an aging population and productivity declining, you have many factors which are contributing to China growth thing. It could be slower than what we expect. So that's the other risk which we can think about. The other context, which again, all of you talked about here, Jay, Thomas, and Sajid, in terms of financial tightening. Financial tightening is something that could happen more abruptly than we expect right now. So that's the other risk, which I would say. And on top of all of that, what we are seeing are signs of fragmentation, whether it be in technology, whether in finance or elsewhere. That's a key risk which over the medium term. Going back to the point you had made, Sajid, I think you raised it very well. I think our line is very clear. Exchange rate should be the buffer against shocks, right? Unless there are some very disorderly conditions which risk financial stability or undermine inflation expectations and so on and so forth, exchange rate should be the buffer against shocks. And you don't see that here. The other point you made on the fiscal, absolutely right. Tax mobilization in this region is abysmal. If you look at tax collection across all countries, whether it's emerging, the countries we have programs with, Sri Lanka, Bangladesh, tax mobilization is really bad. So that's where you have to make greater efforts. On your point about structural reform,
It's never too late. It's never too early. You have to do it. Right now, everybody is focused on short-term policies, rightly so. But short-termism has to give way to more longer-term reforms, which will give boost to the economies of this region going forward.
I think we saw some of it in Jay's presentation as well, that the only way China could come out
Yes.
when you're looking at productivity falls, when you're looking at an aging population, is some serious restructuring. So,
and it's not just about China. I mean, we have lowered medium-term growth for the whole world. It's at 3% medium-term growth. It's never been so low. So all over the world, you have issues which need to be addressed by structural reforms. I gave the example of China because that's in Asia. We see the risks there. But if you look at countries in Asia, whether it's the ASEAN countries, whether it's India, whether it's China, structural reforms are needed. And it's, the earlier you start, the better off you are. Of course, India has done many of these structural reforms in the recent past, digitalization, infrastructure and so on, but a lot more is needed. Same thing for other parts of the world and in Asia.
Thank you. Thank you, Krishna. I would like to now move a little inward towards India. Madan, my next question is to you. See, we got first quarter GDP at about 7.8%. We got a decent uptick in PFC, private final consumption expenditure. We also got good growth in investments, which was front-loaded capex, as also came out in the presentation here. But as we know, a revival in private corporate capex is key to sort of sustaining this growth momentum. And in a pre-election year, we know that there is uncertainty. But how do you see this panning out?
Okay, so if you actually look at private investment, I think this is something which was not quite picked up, even from the pre-pandemic times. Okay, so the pandemic was probably an aberration. Even in 2019, if we had this particular discussion, I would say that the major problem we had was that private sector investment had not quite picked up. That is, ever since we had the AQR, we had the bad loan syndrome which came through. I think the overall slowdown took place in investment in India. And I remember there was a time when we had a gross fixed capital formation rate of 33, 34%. We went down to 26. Today, probably we're hovering around 28, 29%. And a large part of the investment which is happening is coming through the central government, because the central government it has certain plans on certain sectors like roads or railways, where we have seen a lot of investment coming in. And they're not really bogged down by the FRBM rules, unlike the states. Since the states have to adhere to the 3.5% norm, which has been set, they normally tend to cut back on capital expenditure. So therefore, there has been some lacunae as far as the state governments are concerned. Now, if you look at private investment, what we have seen is that it's been very much skewed. So all industries which are infrastructure oriented have been investing. So even today, for example, if you look at the investor presentations of the steel companies, cement companies, they say that, look, we're operating at over 100% capacity utilization. And that's one of the reasons why we see investment taking place. But otherwise, if you're looking at consumer-oriented industries, I think that's where the major problem is. Because when you spoke of consumption, I've always believed that India has not really created the kind of jobs which we apparently seem to be creating. Because if I was creating worthwhile jobs where people have a sustainable income, they would be spending more, they would be consuming more. As you consume more, you will be having better capacity utilization rates. And that at that point of time, companies will be willing to invest. So interest rate actually is not a deterrent, because even when interest rates were very high, companies were investing when the economy was doing well. So I think the fundamental problem is that we need consumption to revive. So I think almost every quarter, we keep saying that we expect demand to revive in the next quarter. It's become a kind of a rolling target, rolling optimism. But I suppose all CEOs, when they make the investor presentations, they can't say that, look, we are doomed and damned for this particular year. They have to say we expect second quarter, third quarter, fourth quarter, next year. So I think it keeps going on. Otherwise, the share price will fall, and I think NSE will have a problem when you see a run on stocks. So that's, of course, a different issue. So therefore, I think it's generally, so even I think today, I think HLL has brought out the results that again says we're looking for rural demand to revive. So we keep saying we want rural demand to revive. It doesn't seem to be reviving because we're not having enough income being generated out there. So there's been, if you look at the revised, I think the third or fourth advanced estimates or the final estimates of agriculture, it shows that 22-23 was not as good as what we made out. So I think these numbers, of course, are subject to changes. So I think rural demand has been one thing, urban demand has been another issue. And I think whoever in the corporate sector here will be complaining, saying my increments are not that good, so therefore I'm not able to spend. Add to it, we have high inflation. cumulative inflation of around 25% if I look at 3 years and half year now, which means my purchasing power has also come down. So I think that's what's really coming in the way of consumption. And I think most of the jobs which we have created have been more in the service sector. You have these Swiggy guys who are roaming around. In fact, when I spoke to some of these Swiggy guys, pre-pandemic, they were earning 45 rupees per order. Today they get 25 rupees. And that is subject to getting 1,200 rupees per day. So they have to make some 30, 40 orders, start from 7 o'clock in the morning to 10 in the night. If we are creating these kind of jobs, construction jobs, I don't think we have that kind of spending power. So I think that's one of the major reasons why investment has been lagging. And now if you're asking me, is investment going to turn around? It's going to be a very, very slow process. So private sector investment, what we have seen from CMI data, which has come out for the first 2 quarters, it shows that it's lackluster. And if at all anything has happened, the large number which came in Q1 was because I think Indigo or Air India have placed certain orders or said they're going to buy certain aeroplanes. Otherwise, if you see limited kind of investment announcement in the infrastructure sector, and definitely nothing substantial in the consumer space. So in short, I think we'll have to wait for a longer time. So let's not get carried away by the 6.3% growth rate saying we're the fastest growing economy. Yes, we are the fastest growing economy, but we need to have, does the economy look as good as it looked when we are growing at 8.5% in the early part of the last decade? The answer is definitely not. We don't have that same kind of optimism. Numbers, of course, are very good, but I think the basic issue is that we need to create jobs, create the consuming power, which will actually be self-reinforcing when it comes to investment.
I think that sets the needle straight. But since we are talking about numbers, Madan, I would like to ask, say, Rupa here. No, we did see two-wheeler sales go up. We did see, 20% jump up in two-wheeler sales September versus the previous year. So my question to you is, how do you see consumption indicators through high-frequency indicators coming? Madan pointed out that it will take a while before things pick up. I agree. But how do you see things panning now?
No, I completely agree with Madan because you see, within consumption also, there is a lot of unevenness, what they call as K-shaped pattern. If you look at the high frequency indicators, what typically belongs to the consumption basket of, say, ultra rich or high income groups, like, your spending on high end cars or premium properties. Or
two-wheelers.
No, that's what I'm saying. But within two-wheelers also, you can look at the sales of, say, motorcycles, mopeds, scooters. So what typically belongs to the rural consumption basket, mopeds, motorcycles, there we are seeing sustained contraction in sales. The sales of only premium brands and electric vehicles are growing. But, the scooterization trend, which we had seen for 8-9 years before the pandemic broke out, we are not back to that. So point is, what I'm saying is that for two-wheelers, the sales are still trailing from the pre-pandemic levels because you see, the original equipment manufacturers, they have actually scaled back production of two-wheelers, saying that there are inventories with the dealerships and, they are not seeing strong demand coming. So point is that in consumption indicators, high frequency indicators clearly show that the consumption growth has gained traction only for ultra rich people. But when it comes to masses, middle class or lower income groups, actually we are seeing sustained reduction in demand, whether it is on affordable housing or, fuel consumption. High speed diesel consumption, you'll see good traction, but not the diesel consumption, of the masses, or even consumer durables. If you take domestic consumer durables production growth, in last 12 months, out of 12 months, for 10 months, it is in the negative growth zone. But imports of electronic items, they have been showing good growth. So point is that we clearly see unevenness in consumption recovery. Simple thing like, direct taxes versus indirect taxes growth. You see, quarter on quarter, we have seen slowdown in direct taxes growth, but indirect taxes growth has been good, GST and all. That also is indirectly showing the unevenness in consumption pattern.
I just had a question here. I mean, wouldn't you expect direct taxes to be paid by a far smaller segment of the population versus indirect taxes, which are paid by pretty much everybody?
Yes, yes. But you see, the GST collections, and if you see its breakup, it's primarily, coming from the high-end consumption items. So, I mean, what I'm saying is that every additional data point actually points to this. And two-wheelers, it was affected not just because of this lack of purchasing power at the masses level, but also because the demand for that is leveraged in India. And high real interest rates, definitely have impacted demand for these leveraged products like two-wheelers, home loans, etc. Because at the margin, it makes a difference. Maybe for investments, it is not a deterrent, but certainly for leveraged consumption, it acts as a deterrent. And we have seen it. We have seen it happening in our balance sheets. So everybody today is chasing prime borrowers. Why? Because they have the purchasing power. They are more credit worthy.
What kind of indicators would you generally see as turning around to say things are actually changing now on the ground? Two-wheelers is just one, but otherwise, what high frequency indicators would you look at?
No, that's what I'm saying. See, consumer durables, consumer non-durables, it's not at the aggregative level, but we also see the breakup. We also see, various product groups within those baskets. Now, for many, you see, Madan made this point of employment not getting generated adequately. Now, that gets reflected in your manufacturing sector data. Because if you look at the actual indices, for those 23 industries within the manufacturing sector, almost for 12 and 13 industries, the indices are still lower than their pre-pandemic levels. So the recovery of manufacturing sector has not happened. It has not created jobs. So at the mass level, we have not seen any upsurge of purchasing power. So we can't expect. See, festival time also, you may see some kind of pickup, but it is not going to sustain.
What's your sense of this?
Tirthankar, sorry, can I just interrupt you here? I think this, when you're talking of high frequency indicators, I think PMI manufacturing services, GST collections, they're extremely misleading. Because the last 1.5 years, we've had such superb numbers, but they don't seem to be get reflected when you look at corporate performance. So, of course, corporate performance is only the organized sector. We're not looking at the unorganized sector. If you look at the first quarter, if you leave out the BFSI sector, there was negative growth in sales. But your PMIs are doing great. And we said GST is doing very great because it's a consumption-based tax. So therefore, people must be consuming more. So there's definitely a disconnection between these high-frequency indicators, which I think have always been misleading because they don't reflect actually what's happening. I think corporate performance is a very good indicator.
You did mention that, for FMCG companies. Absolutely, that's a good idea.
And for PMI, it is not representative because it takes into account only 500 top-level companies. See, even for financial results, if you keep adding smaller companies, they don't change the actual results. The core sample matters in that. So corporate earnings results actually, every quarter when we see it, now we are talking about early signs of weaknesses in rural demand. It's already reflected in the FMCG majors volumes growth.
So that point is well taken.
Yeah.
I just had a question. So we see this rotation from goods to services across many countries. I guess it's cyclical. It has to come back, right? And Madan, you also said we had to wait. In the meantime, we have the government, which is putting a lot of resources into capex, which is good. Infrastructure spending is good, it's productive, and so on and so forth. So the question is, if we see the rotation coming back towards goods, and at the time when the public is spending on capex, will growth be much higher in the future? Without this, you're getting 6.3%. So the question is, will it be? Sorry, I took your job for 2 minutes.
I'll tell you what the thing is here. I think when we keep saying central government is spending on infrastructure, you should remember it's a very small component. See, India's GDP is supposed to be 300 lakh crores, approximately. 30% is capital formation, 100 lakh crores. How much is the central government spending? 10 lakh crores. So 10 lakh crores cannot move 300 lakh crores. Private sector investment is absolutely required. And I think the privates, and always as a case of saying, you ask the private sector, they'll say we're waiting for government to spend, and it will be crowded in. The crowded in economists keep talking like this, saying that government spends, private sector investment will crowd. It hasn't happened for 4 or 5 years. See? Because private sector will not crowd in unless they see a profit. They are looking at a return on capital. Government does not have to see on it. So unless the government is willing to run higher deficits, increase the 10 lakh crores to 20 lakh crores, then we can see something actually earth-shattering happening. Otherwise, we'll be crawling around like this.
So if I see two conditions for private corporate capex, Sajid, your points, private corporate capex to come in, the first order condition is, do your balance sheets allow it? The second order condition is, do you have demand? I believe the first order condition is met at the moment. We no longer talk about the twin balance sheet crisis and so forth, but the second order condition is probably not around there. Is that a fair take on this?
Yes, demand is a fair take. And also, it is there also there is unevenness because, all this infrastructure push given by central government and now state governments also, we have seen that some of these states,
CapEx, yeah.
yes. So, that has helped certain sectors, like we are seeing it, infrastructure, capital goods, construction, etc. And all, even MSMEs, which are providing support, back-end support to these factors, they are doing well. But beyond that, it's not broad-based. It is concentrated in these few sectors.
I agree. Your thoughts?
So let me just, to answer Krishna's question, kind of pose two facts that surprise most people. So if you just look at GDP growth from March 20 to March 23 over 3 years and look at the CAGR, what most people are surprised to realize is the role that exports played. In that 3-year period, GDP growth, the CAGR was 4.5%. The CAGR of exports were 12.5%. Right? So exports played a disproportionately large role in driving growth over the last 3 years. Now that engine at some point is going to stop, and it's begun to stop already. April to June, exports contracted, number one. And when you look at the good news on exports was first it was goods in 21, then it was services for 22 and 23. Now on the services front, again, from a level perspective, this is good. Gross service exports, these are not just IT, but JP Morgan, for example, has 55,000 people in India. So this is now non-IT higher value added services. It's research, it's legal, it's accounting, right? Mercedes-Benz, about 6,000 people here designing their cars. So this is all very encouraging. But what we've seen in terms of growth rates is it surged, and now in level terms, this plateaued out. So you went from 18 billion a month gross service exports 4 years ago to 21, then to 27, fourth quarter last year. For the last year, we've been in that 27, 28 billion.
That's how we reached 300 plus billion.
Correct. But now we've plateaued at that level. Let's hope and pray that you get another burst of growth going forward. So the first question is going to be, if the tailwind from the global economy, right, the points that Jay made are going to reduce both in terms of goods and services, then domestic demand has to take on a larger responsibility. If you cut it by industry and services, here's the surprising part. So most people believe that services are surging in India because you go to a restaurant, it's full, you go to an airport, it's full, right? But look at what the GDP data tells you. If you draw a pre-pandemic path for services and industry is back on its pre-pandemic path, right? Despite our concerns about manufacturing. Why? Because a lot of industry is tradable, right? And the fact that exports were strong for 18 months helped you get back. Services growth, despite picking up the last 2-3 quarters, are 8 to 9% below their pre-pandemic path. Services used to go at 7-8% pre-pandemic. Now, why does that matter? Because services are very labor intensive, right? So if there is a concern, rightfully so, that Madan and Rupa have expressed about blue collar job creation, it also goes back to the fact that the labor intensive services sector is still much below its pre-pandemic path, and that helps explain some of the scarring in the blue collar market. Now, the puzzle is, how come service exports are doing well and services are weak? Because
not just that, one more question to you. What would then explain the first quarter double-digit growth in services?
Yeah, so I don't want to spend, if we have a discussion on GDP deflators, we can be here for 3 hours. No, but remember the base. So you had last year's services growth was depressed. So I always say, instead of looking at any quarter's growth rate, look at levels. And from a level perspective, 3 years later, we're still 7 to 8%. Hopefully, fingers crossed, we'll continue to make that gap up. Right? I guess the second point I wanted to make is, if you look at the nature of consumption, was a very interesting dichotomy between China and India. So China economist Haiben tells me what was revealed in the data yesterday that came out is in Chinese consumption. See, consumption is lagged in both countries, but who's spending is very different. In China, Haiben tells me that the lower middle class have begun to come back from the villages to the cities, right? Their job prospects have improved. They've begun to spend. The precautionary savings is largely at the upper end, white collar jobs, because they're worried about investment and the state's involvement and the regulatory crackdown, right? So it's really the poor that are driving consumption in China vis-a-vis the rich. In India, it's exactly the opposite, right? That you've got this, that it's disproportionate spending at the top. We see this in autos, you see this in the housing sector, you see this in jewelry, right? Right. And so this is a very interesting dichotomy that you've got the upper end spending in India and the lower end spending in China. But the last point I'll make is if domestic demand has to pick up the slack from external demand as that slows, you've got a mix right now. Public investment doing a lot of the heavy lifting. But remember, we've got fiscal deficits that have to come down in the next 3 years. So there's a limit to how much that can happen. The good news on private investment, as you pointed out, is the 10-year twin balance sheet constraint is finally gone. This is not a structural impediment. This is now cyclical. Hopefully in a matter of, see, it's hard to expect people to invest given the state of the global economy. Uncertainty is at multi-year highs. Interest rates are at 2-year highs, right? So we'll have to wait a few quarters for this global uncertainty, soft landing, hard landing, US exceptionism, US 10-year yields at 5%. That's not a good environment. Middle Eastern boil, crude prices at 90. That's not a good environment to trigger investment. So the good news is the private sector is getting closer, but you need broadening from public to private in investment and broadening from upper end to lower end in consumption.
I have to ask, since you did touch upon some of the international aspects here, the dollar index is at 11-month high at the moment, and it's up nearly 3.5% this year. You also showed that in your presentation there, and you did speak about US states staying higher for longer. So where do we see the rupee heading in this way? I think some of the direction came from your presentation as well, that central bank should allow the exchange rates to move in the right direction there. But how do you see? How does the panel see the INR heading? Yeah.
See, even at the current level, in RER term, rupee is still overvalued. So point is that personally, I feel that if you look at the history of inflation differential between India and its major trading partners and the actual depreciation of Indian currency, only in crisis episodes, rupee depreciates. But otherwise, there has always been a, overvaluation of the currency. So depreciation of rupee per se will not be bad, because we all know that, when exporting sectors were doing better, they were acting as a growth driver for the overall economy. And if rupee depreciates, and of course now we have comfortable cushions, so RBI will definitely see to it that there will not be any disorderly movement in the currency. They will see to it that the depreciation happens in an orderly fashion. But if rupee depreciates, say 85, 86, actually it will help the exporting sectors and the competitiveness. So
also take off some of the shocks that we are seeing.
Yes. And RBI also, because we have seen that dollar reserves also have come down from 645 to now 584. So, and now we have this higher interest rate environment. Liquidity tightness, aggressive intervention by Reserve Bank of India adds to further liquidity tightness. So, allowing rupee to take some pressure always will help.
See, actually, Tirthankar, I think one can never guess where the rupee will go. Because I remember when we started the financial year, everybody said 80, 82. Some people said 77, 78, 79. We went below 80. Then finally we come to 82, then we say 82.5. Then it comes to 83, now we say 83 to 84. No, and the fact is that honestly nobody can tell, because we don't know what's happening to the dollar, how strong the dollar will get. We never expected dollar will reach parity with euro last year, which happened. It's again probably going to happen. And I think that's been one of the factors which has been driving all currencies down. And I think the Reserve Bank of India has always ensured that the depreciation which takes place in the rupee is somewhere along the median line. So if I look at the top 20 currencies and then say how much has the rupee depreciated, we'll be somewhere at the median level. So I think there has been some conscious, the RBI will never admit it, saying that they're controlling the currency. They say we only look at volatility. Yeah. But I think if you look at it exposed, it looks like that the RBI ensures the rupee does not depreciate too much to create panic, because that becomes self-fulfilling. At the same time, we don't lose out on the so-called export advantage because of having a currency which is stronger than what it should be. So I think that's how the rupee is going. So today, we don't know where crude oil will go. We are saying 90, it can go to 100. Tomorrow, it goes to 100. All of us will say 120. The moment it comes down to 100, we'll all bring it back to 70. So I think, honestly, in this particular game of Forex, crude oil, nobody can actually take a guess. It's more a case of adaptive expectations. Today, it crosses 90, I'll say it'll test 100. Once it crosses 100, I'll go beyond that. So the same thing happens also for a currency.
I may ask, what kind of sensitivities are you working with? So,
if you look at, what is happening to the dollar is one part which has been driving the rupee. Now, how much of it is affecting? Hard for me to guess. I don't know if anybody has an answer to it. But if you look at our fundamentals, we all started out by saying current account deficit will be 1% this year, 1.5%. Now we're talking of 2%. So we're not sure of what's going to happen because of the crude oil effect. Similarly, we said export of services are going to peak. People spoke of huge numbers. Now suddenly we're saying that, look, there's a problem. No, earlier we said US slowdown, it didn't affect our export of services. Today we said because of US slowdown, exports are not growing. Okay, and yesterday, I think our 3 top IT companies say they're sacking people. Then we're saying, okay, they're sacking people because they don't expect good revenue to come from the US. So I think because of the uncertainty, I'm not criticizing anyone, because even I've been saying the same kind of things. But the thing is, things are so uncertain, it's very difficult for one to guess as to what's going to happen. We felt that FDI, India got $80 billion, look, we're going to get 100. We fell to 70 last year. First quarter, again, we have fallen down because there are fewer investable resources which are available. So I think when it comes to currency, anything to do with the external sector, given the fact that we might have decoupled growth from the West, I think that's why India is doing much better. We're a domestic-oriented economy. I not fully agree with you, Sajjan. But the fact is that we cannot escape what happens in the West in terms of currency, in terms of investment flows. So FPI suddenly took a negative. 1 month, we're very happy saying that FPIs are coming in. Everybody believes in the India growth story. Next month, they don't seem to be believing in the India growth story. So I think things are very, very uncertain. So I think it's hard for one to actually take a guess on it. I think based on our understanding, and maybe because all of us have worked as economists for 20, 30 years, we think we're more intelligent than others. We take a view and say, okay, it's going to go to 83, 84 or 82. But honestly, I believe it's very hard to say because conditions have never been like this in my last 35 years.
So, but what I'm reading from you, Madan, is there is a definite depreciating bias on the currency. I'm also reading the point that Sajid made earlier, that in this uncertain environment, it's hard for a private guy to put up capex. That's also, when that overhang remains, even though we don't have the twin balance sheet crisis at the moment. So that uncertainty remains.
Demand. Somebody says that PMIs are going up, so demand is high. Everybody is optimistic, but unless you spend the money, only then will I get to know demand is there, and that's when I start investing. That's fine. That's it.
Yes, just take 10 seconds to say, I think the challenge for emerging markets that are both commodity and capital importers like India is that the natural hedge that we used to rely on is broken down. What do I mean by that? That remember, dollar and oil used to be inversely correlated. That strong dollar used to mean softer oil, higher oil used to mean softer dollar. And so if oil prices went up and the current account would widen, it was also accompanied by a softer dollar, which drives capital flows, and the capital account would get relief, and vice versa. The stress last year was because for different reasons, both these things moved in tandem. The Fed was galloping, so the dollar strengthened, and because of the war, you had oil prices go up. And so what you saw was this double whammy, where the current account widened and the capital account saw outflows. And the concern is the last 8 weeks, we're seeing a repeat of that. That for different reasons now, I think because of US exceptionalism, and we've just marked up our third quarter US GDP forecast to 4.3%. Who would have said sitting in Jan that after 500 basis points of rate hikes by the Fed, third quarter is 4.3. The Atlanta Fed is at 5 for the third quarter, right? So the US is clearly outperforming. Europe has come to a stall. China is disappointed. This will mean a stronger dollar. And because of supply shock reasons and what's happening in the Middle East, oil is high. I think it's that tension that you get a stronger dollar and a higher oil at the same time that puts dual pressure on the BOP. Now, not to say, I think in terms of reserves, we wrote a note saying it's the 10th anniversary of the taper tantrum. And frankly, nobody even knew that India was under more pressure last year than we were in 2013. Nobody knew, nobody noticed, nobody flinched, right? Because we've got massive amounts of buffers and macro fundamentals, any which way you measure them. Inflation, real interest rates, current account are in much better position now than they were in 12, 13. So there's no financial stability risk at all. But this does put external pressure on Asian central banks. The fact that you've got both these things happening in tandem, I guess, is the limited point.
I mean, our drawdown in reserves, last year was double that of 2013.
A lot of that was valuation effects because of the stronger dollar, right? And the fact is, if you use any metric of reserve adequacy, you use the broadest metric, that for the next 12 months, your entire current account deficit and all debt which comes due in the next 12 months, right? Residual maturity of 12 months, you would expect to have a statistic of 1. You must have at least as much reserves as that. In 2013, we were 0.9, close to 1. Now we're 1.8. We're double of that. So by any measure, we've got significant reserves and then some.
Krishna, my question to you now is, are we at the end of the hiking cycle?
Well, here, I'm not going to talk about India, but overall, I think it's not clear, right? Because the economy is really heating. The labor markets are still very tight. And so you can't say for sure. And there is uncertainty here. And, there are inflation pressures building. So I can't say that for sure. But I think I would go back to some of the points made by the others. Uncertainty is very high. You're seeing lots of shocks. The shocks don't seem to dissipate. And I think on the exchange rate, we have to allow the exchange to be a shock absorber. And I think that's what something... is a reason. If the conditions are very disorderly, if there is massive movements one way, then you could think about intervention. But otherwise, having the exchange as a shock absorber is one thing which we talk about. In our Rio, we talk about the fact that at this point in time, what do we need countries to do? One is we say build buffers on the fiscal side, on the financial side, capital liquidity buffers, and allow flexibility exchange rate. So those are things you need to do to build resilience in the economy.
I think some of the things the RBI is already doing, right?
Yes.
Exactly in the same direction. Rupa, my next question is to you on CapEx, frankly. We did discuss it a little bit, but look, this is a pre-election year. Usually, fiscal attention shifts towards revenue expenditure in a pre-election year from CapEx. But what's happening is the center is actually front-loading CapEx this year. The number, as I'm seeing here, is at 37% of budget estimates, which is already 4 percentage points higher than last year. While overall capex remains strong, and this point also was alluded earlier, states do not have this flexibility. They work under much tighter fiscal numbers. So there is significant interstate diversity, in capex. How do you see overall government capex faring this year, and how do you see that happening for states?
See, within states also, we are seeing a lot of divergence in capital spending. Some of the states like Andhra Pradesh, Telangana, they have been really doing well. Even smaller states like Orissa and all. But larger states like Gujarat, Maharashtra, Madhya Pradesh, they have undershot their budgeted capex targets, even in FY23. UP has been doing well, but if you see in terms of growth, then it is not much. They are attracting a lot of investors and all, but still, at the top, if you see in terms of ranks, it is somewhere in the middle. But what I'm saying, the large states like Maharashtra, Gujarat, Madhya Pradesh, they have undershot their, budgeted capex for FY23, and Maharashtra is lagging behind even in FY24. So, but point is that if you look at the history, in a pre-election year, we always see investment projects slowing down because of now we have uncertainty created by all these external factors. But more than that, the pace of project execution slows down because investors, entrepreneurs would like to know which regime will come, what will be their policy thrust. Because, if you look at the data on cost overruns, time overruns also, the picture is not very encouraging. So personally, I feel that in the second half, this 48% growth, which we have seen in central government capex in April to August, that may not sustain. It will certainly come down, and there will be more spending on the revenue side and give, subsidies,
expect the second half to
etc.
slow down, of course, but
Definitely.
front loading. What's the idea?
Front loading because they indeed felt that these industries have stronger forward linkages, and through multiplier accelerator effect, it will improve the investment sentiment and bring in more of private sector capex. But that has not happened actually. And as I told you earlier, even today when we see the manufacturing sector, the recovery is not broad-based. See, I work for a company which is in this infrastructure, engineering goods. We are seeing very good order book and growth traction, in capital goods sector, infrastructure, construction. But it's confined to that. Other sectors like intermediate goods, consumer goods, we have seen that the growth is still quite lackluster. So point is that government has fiscal constraints. They've already spent so much, and if it is not yielding desired results, they are going to concentrate more on election outcomes, freebies, increasing subsidies rather than increasing capex in the second half.
One might probably see some revenue expenditure.
Yes, because if you see from 2004 onwards, we have seen every general election, general election year, investments, central government's capex has come down.
I will also see that our current capex as a percentage of the budget is about 1/5 from this budget. So there has been a renewed thrust towards capex as well. I agree with Madan that this is probably not enough to move the needle because it's not large. After all, when you're spending 10 lakh crores on a number of 100 lakh crores, the government has been doing the heavy lifting over the last few years. I would now open up the round for questions, open up the panel to questions. We have Aditya there. Can somebody provide a mic to Aditya, please?
Do I need to start? My name is Aditya Seshan, and Madam, my question is to you. You said that it is the ultra-rich who are buying the goods rather than the man on the street. How do you explain the situation where people's aspirations and expectations are getting better than before? As an example, the number of two-wheeler riders have actually shifted to four-wheelers. So isn't that also contributing to the high-end purchases? There's a lot of upgradation going on. Do we talk about that?
Just one number, just to give you numbers. Please have a seat. India is one of the world's largest two-wheeler markets. So we buy about 12 million two-wheelers in a year, more than 1 crore. But our car purchases are about 4 million, just give numbers. Rupa, yours.
Yeah, no, I'm not denying that. I'm saying that, even within two-wheelers, if you see the demand, it is primarily for premium brands and for electric two-wheelers. But, the kind of, because we have a very large market in large urban market for our two-wheelers business. And we are not seeing that kind of demand pickup in our portfolio.
Madam, nobody buys a Luna moped anymore. The starting bike owner wants to have a median brand and then move upwards because also the leverage is available today. I mean, from holidays to buying motorbikes, everything is available on EMI.
No, sir, but within two-wheelers, if you see rural folks, they purchase mopeds and motorcycles, and in urban areas there is more preference for scooters. So we see a very strong correlation between rural incomes, rural demand, and demand for mopeds and motorcycles.
Thank you, Rupa.
As a supplementary to what Aditya said,
yes, please.
We are also noticing that the unsecured loans have actually grown. So how do you explain that? Because and that's what even RBI is a bit worried about, the growth of unsecured loans. Obviously, consumption is taking place. So I am slightly, and question is to Madan, because Madan said that.
Yeah, see, actually, when you're talking of borrowing for consumption, I think why RBI is worried is that, see, if you borrow for buying a vehicle or you're buying a house, there's an asset which you're purchasing. Whereas when you're buying for consumption, there is an issue which is there. Now, why they're borrowing for consumption? Because funds are available quite easily. Because I think with these fintech companies, you can just go online and do it. Now, is there a risk? Now, there are two parts to it. One is to say whether it shows that consumption is taking place. Yes. But as I mentioned earlier, there has been a very high amount of inflation. People are aspirational. You want to consume things. You don't have the wherewithal to do it. So therefore, you use leverage for that. Now, second, is it actually a problem? From what limited amount which I know, I work as an economist in a bank. I'm not a banker. But normally when you get it, when you take a loan, it's normally given to people who are already salaried income. So as a bank, if you are my client, you're my salary account, all your employees are offered loans up to 5 lakhs. So therefore, there's a guarantee that I'm going to get my money back. So if you look at what has been the delinquency rate on these loans, it's very, very low. It's very, very marginal.
So I had a linked question to this. See, last year's credit growth was decent, double digits, 13, 14%. But 70% of it was taken on by retail sector, not large corporate capex. Any comments on that?
So that's because private sector investment is not taking place. So therefore, people are not borrowing from banks. Even if you look at the corporate bond market and see what are the issuances, 85% this year is from NBFCs. So we don't have companies coming in purchase and borrowing. So you normally, if you have to invest in capital, you will be borrowing either from banks or from the corporate debt market. Of course, corporate debt market is meant for highly rated companies, but we're not seeing that really taking place. So, and banks also, after the AQR, we had the NPA problem, especially in the public sector banks. There was a conscious focus to try and de-risk a portfolio. So therefore, they were focusing a lot on retail loans. So the big push was being given to retail loans because it is believed delinquency rates are lower. Of course, what happened Lehman crisis was based on retail loans, but one assumes that that kind of a scenario will not be repeated.
It has been taken cognizance of anyway in the recent governance. Next question. Please.
Yeah, my question is, there structural reforms were suggested, and to particularly also India or other Asian countries. So, particularly for India, maybe that we expect after inflation, our election only. What are those suggested areas of structural reforms? And also, what are the new drivers of economic growth? One is we are growing 6.3, but it is not a comfort zone. Because others are not growing, we may be growing. So, in the view of Dr. Krishna Srinivas, what are those areas?
So, when we talk of structural reforms, these are country specific. But in general, what you see in Asia is productivity is declining across many countries. And so, all reforms which go towards boosting productivity will be very good. In the case of India specifically, I think what they have done on digitalization, India has done on digitalization is very good, it's very impressive. The push towards infrastructure is very good, but I think the areas where more work needs to be done. One, I would start with liberalizing trade. I think there are domestic compulsions, but they have imposed some trade restrictions, which if you want to really reap potential, be more integrated, they need to be addressed. Talk about reform education. If you want to talk about increasing productivity and creating a skilled labor force, you have to invest in education. I think that's where a lot more needs to be done. Similarly, on health. Talk about labor reforms, talk about land reforms, agriculture reforms. There's a long list. Okay, you have to prioritize that, and it requires consensus building across center and states. But that needs to be done if you want to really reap the growth potential. I mean, for rest of Asia, again, it's very specific, country specific. But in China, for instance, we've talked about SOE reforms, which kind of creates a level playing field between SOEs and private enterprise, what we call as competitive neutrality. So these reforms are specific to a country, but in India, you have quite a few. And, the sooner you begin, it's important.
Wouldn't this be an issue in a democratic process which we have in India? So it's easy to say we need land reforms, but if you see the genuine problems which are there, it's not easy to sort out. Yeah? I can assure you that, because when you're talking of land reforms, like if I tell everybody in NSE that I want to build this metro corridor or something here, you please relocate and go to Dombivli and stay there. Will you all agree? No. Why should a farmer give up his land? So there is a political economy situation out here in India.
No question about that. I'm not saying it's easy, but these are things which need to be done.
No, but I'm saying that in fact, that's an issue I've always had when people say structural reforms. Please tell me, because I think this particular government has gotten a plethora of reforms which have been acknowledged. But when you're talking of other things, what exactly are practically feasible?
Nothing is ever easy in India. We've seen it. I mean, You've covered it for 30 years. I'm covering for 20 plus years. Nothing is ever easy. But
I'm saying, practically speaking, everything
right
has, when you're saying that the growth is being held back because we need to have more structural reforms.
There is, right? I mean, RBI also puts out that there is a positive potential.
No, all of us economists, even if I have to say, give a lecture somewhere, I will say these are the structural reforms required. But let's be practical about it. Yeah? Are you going to say today, for example, I thought the farm laws were very progressive because the kind of system we have in agriculture, we require the farm laws. But then when you have opposition and you have killings taking place, it makes sense that any sensible government will withdraw. So I'm saying in a democracy, you're talking of China, you have a dictatorship, you can do anything you want to. Even if people are finished off by the government, you won't be aware of it. Whereas in India, it becomes a huge issue. Every TV channel will be talking about it. So I think political economy is an important thing we should recognize whenever we talk of structural reforms. In fact, I feel that agencies like IMF and World Bank should actually recognize it. Rating agencies should recognize that when you are looking at a developing country, you cannot use the same kind of yardsticks what happened in the US.
But isn't that the point Krishna is making? I mean, the recipe is country specific, isn't it?
No, country specific, but I'm saying you have to distinguish between the emerging markets and the developed countries. You cannot have a single kind of a rule which fits when you're talking of reforms.
These are country specific. Sorry?
Ask the question on
it is country specific.
And I'm saying when you're talking of Indian structural reforms, I can counter argue to everything what has been done and what cannot be done.
I think he asked a question where everything knows the answer, and yet, I mean, like Sajid said, we can have another discussion only on structural reforms.
So there are like labor market reforms are happening. They are happening slowly, but they're happening. So you have to continue that. Trade reforms can happen. It could be easier than other.
Even you're talking of trade reforms, for example, the whole world is worried about Chinese imports coming in and swamping the market and affecting the economies. So when India says that I'm going to ask for a licensing, I find nothing wrong in it. They have not banned imports of electronics. They're saying we just want to see what is happening because there's a PLI scheme which could be misused for getting hold of it.
I don't think Madan is arguing, Krishna is arguing against that.
No, we're talking of trade reforms and bans. I'm saying this is a practical issue which is there.
And I think, I mean, in the Rio, there is acknowledgement of the steps that India has taken. I mean, I don't think there is anything contrary to what you're saying that Krishna is pointing out. Next question, please.
What is bilateral trade? Not good. I mean, you may want a bilateral reform, but you are doing these free trade agreements, say with you have done with Australia, you've done with UAE. Those are all good and all the right direction. So those are kind of things which will get stepped up. So there are reforms which are easier. In fact, let me give a very concrete example. When I worked in Brazil, right, we talked about structural reforms. Again, you can be cynical about it and you can say nothing can be done. But what we did was we looked at the intersection between what is acceptable to the public and what is really needed. So prioritization of structural reforms and intersection of that with public support. And that did work. There was an intersection. So when you try to prioritize structural reforms, it was done. So the big reform was on financial sector. Right? And there was a lot of support from the public, and they did it. So you could think of reforms, prioritize them in such a way which are more acceptable to the public. Go with that first. No, I'm sure there's more. I mean, there's more that we have to think. So it's if you're done, yeah, GSC is one exactly. So there are things which are done. So it's something which may look impossible, may be possible, but you have to work on those. I mean, you can't give up.
Just one point, because I support what Madan has said. See, for financial sector, generally the lobbies are limited. Political problems, sensitivities are limited. They are more in the case of real sector. For instance, I have this specific issue about land reforms and, to boost investments, we have to speed up getting environmental clearances, this, that. Today we are seeing, huge risk coming from the climate risk area, global warming, this, that. When we make these kind of statements, whether we are holistically thinking about it, because, when we are, suppose if you have a seminar on climate risk, environmental disease, can we say that, we should speed up land reforms and things like that? So point is that, it becomes very easy to say that we need these reforms to facilitate, but the problems at the ground are of a different nature. And in a political economy setup, what kind of solutions we can offer?
I think the way I would look at it, look at this, Rupa, is that we know the answer. We know the answer to that question. I think the point is, how do we implement it? How do we get towards that solution? Your point about, climate risk is well taken. But we should also not forget that India's commitment to climate change has been huge. We are the ones who are saying that we will get to net zero by 2070. We are the ones who are saying that half of our energy production would be by renewable energy by 2030. We are the ones who have over 125 gigawatts of renewable energy production today in this country. And all this has happened in the last 10, 15 odd years. So I think there are difficulties. There's no taking away from that. But over the last few years, we've also seen some success happening. But Narendra sir, you hijacked the question. No more questions for you. I'm sorry, sir. No. No, please. Sir, we have several people behind you. No, please.
Underplaying India's efforts, but I want multilateral organizations like IMF or World Bank to really deep dive into this and give us some practical solutions. Because point is that you see recently Mr. Shankar Acharya had penned a very good article on the same theme, and he said that the generation born during 1940s and 50s was the luckiest because they saw very limited disruption. But here you see the kind of extreme weather events we are facing every year. Here, so easily we discuss about rural demand, this, that. But I mean, earlier we used to get 4 or 5 cyclones in 8 years. Now in 1 year's time, we are getting 80 cyclones. All of so many floods, this, that. So point is that, what do we, I mean, the whole concept of structural reforms, we need to do deep diving and, what is going to work and what is not going to work.
I couldn't agree more.
Hello. Yeah, so I have one question. I'm Sivraj from Mauritius. So my question is open to everybody, and thank you, Dr. Rupa, for bringing our the climate issues. That was my specific issue that I was going to bring, especially to IMF economists and also to the panel. I mean, we're speaking about the economic outlook in the region, but has this climate crisis been taken into account while we come out with the figures, especially in terms of the forecasts? Because every economic modeling that we come with is based on past data, but in terms of the forecast that we're seeing, that is the world in terms of the growth is going to be down, except for India probably. Has the climate crisis been taken into account? If yes, it's okay. But if no, is it going to, the numbers are they going to be much lower than what it is being forecasted?
I think that's a fair analytical question.
So again, the answer would be yes and no. In some countries, I mean, you said you're from Mauritius, right? So for some of the smaller countries, which are more vulnerable frequency and severity of crisis, we do try to take into account what is the average loss of natural events and put them into the macro framework. I'm not saying that we do this for all countries consistently, but for some smaller countries, because I used to work on the Caribbean countries when I was in a different job, and now I work on the Pacific Island countries. So we try to do that to the extent possible that we have the estimates. And then we also do something where we try to see what are the possible losses, what more do we need in terms of adaptation investment, what is the financing needed, and then we try to estimate how much you can get support from others. So you have to do your bit as a country, and then what more is the gap. So we try to do that for countries. I would say that for smaller countries, we do that more diligently than for the bigger countries.
So we have overshot our time by about half an hour.
Yeah.
There's a long.
Yeah,
please.
I'm a Dr. Sunil Kapadia. I'm independently consultant. I'm also a trainer. Worked in almost 30 years for corporate finance, and my heart is always economist. I just want to understand, somewhere we are saying this country for last couple of years, we have given thrust to some of the areas which we were lagging. Okay? But in what we are also observing simultaneously, some of the areas we are not able to see the real kind of effect by which something is not getting connected. So that was the maybe see infrastructure we are spending. We were expecting rolling out of effects that could also lift the rural demand on a larger effect. The discussion is saying that is not happening. Some of the private capex we all know, even before the pandemic also, they were not coming in. So what is the linkage which is not happening, and what are the learning for all of us that we should be doing going forward? Like, can you throw some light? What could the linkage is, by which, something.
Actually, I think we probably did not communicate, at least I did not probably communicate well with you all. When I said that investment is not happening, I'm not saying zero investment is taking place. It's happening in a very, very skewed manners in the infrastructure-based industries. So when infrastructure does well, there's automatically backward linkages which come not just to the industries linked, but also to the employment generated, which goes across urban and rural areas. So it was for the sake of making sound dramatic, I might have said that, look, we are the same as place as 2019. But definitely when we talk of K-shaped recovery or anything to do with the K-shape, economists keep playing with all the letters of the alphabet. We have some explanation for everything. But for K, we're saying some things are going up, some things are coming down. So that's exactly what's happening. So it's not to say that nothing has been happening. It's been happening, but it's been happening in specific sectors.
Also, I think there are leads and lags of policy. Let me give you an example, right? That we've just started this public investment trust, very impressive from the central government. If the center comes close to its budgeted capex this year, central capex spend would have doubled in 4 years, which is no mean feat. But having said that, it's of a low base. It's 1.7% going to 3.3%. Now, what that means is for private investment to catalyze will take time, because if you look at capacity utilization in the manufacturing sector, it's still around 75%, right? So you need some combination of animal spirits and high utilization levels to trigger private investment, which means that you need more public investment. So the key here has to be that over the next 2-3 years, we've just started this process. You need more public investment so that utilization levels actually reach a threshold, global uncertainty comes down, and you can get a private investment cycle. Second example, the good news, as Madan was alluding to, for infrastructure spend is typically in the early 2000s, you saw that rural wages pick up. You attract rural labor from the rural economy, and that pushes up wages and therefore drives bottom end consumption. We've just begun to see that process happen, right? Rural wages in real terms were negative until 6 months ago. Now they're marginally positive. So I think for some of these issues where the structural impediments have finally been sorted out, right? Whether it's on the bankruptcy law, whether it's on twin balance sheets, we have to give these processes time, but double down, because the global environment is only going to get more and more hostile.
Now, this year's monsoon, it seems it has been very good. So to what extent it is expected to increase rural demand? Yeah.
It was not good at all, sir. It was very, very uneven and patchy, both
adequate,
temporally and spatially. I mean, we had many extreme variations. In June, we had 9% deficiency, July 13% surplus, August 36% deficiency, again September 13% surplus. Our water reservoir levels are also much lower than the last 10 years average, and year-on-year basis also they are lower by 18%. Southern regions, except for Telangana, all southern states have precariously low levels of water reserves. Even Maharashtra, Gujarat, East UP, so point is that if you look at the it's not just the quantum. The distribution of the monsoon matters a lot, and it has been very, very uneven, both geographically as well as temporally. So, and because of this, we had the driest August in last 125 years. See, I spoke about climate risk. These are the real facts. Now they are saying that that is posing risk to our actual yield, the kharif yield, because there has been poor vegetative growth, pest infestations have grown. It has given rise to problematic flower growth in different crops. So actual yield may get impacted.
The EPR team at here at NSE, there is a report in the August edition of our Market Pulse that looks at 120 years of how rainfall distribution has become more and more variable in the country. And it's worth having a look at that report. Any further questions? Sir, you asked one. So resilience is better, but climate variability is a factor. Any further? Yeah, you had a question. Someone give me a mic, please.
Can I take this one up? Yeah.
There's
we are
already one. After them. That's
okay.
it. Last question.
I had three questions, but this is last important question. We have spoken about climate risk. Only one question. I'm saying one question. I'm taking one question, one practical question. We are all speaking about climate risk, and since from bank we are also trying to work our way around climate risk. So whether any practical funding schemes or anything will be coming from institutions like IMF, like for example, if we need some infrastructure investments or some transition projects which needs to be funded. Now here in India, interest cost is very high, and since we are a developing country, and obviously our carbon emission in compared to other developed countries is far lesser in terms of per capita and historical
we
levels.
Speak about narrowing differentials, right? It's not going to be much cheaper anyway.
No. I'm not saying commercial funding. That's what I'm saying. I'm saying like subsidized funding, something like that, some scheme which that IMF can bring to fund developing countries, not only India, but countries like Nepal or say Mauritius, which are at high risk, and to build the infrastructure, say 1%, 0.5% kind of funding, if anything that is coming soon for. I mean, through refinance or something kind you can do, sir, because the banks like SBI, they are doing quite a work in terms of funding ESG projects.
Okay, so I'm not making a selling point here, but the one country which has accessed climate financing from the IMF is Bangladesh. We have a new instrument called Resilience and Sustainability Facility, which is a 20-year loan with a 10.5-year grace at below market interest. It's not that straightforward as make it out to be, because you have to qualify for it and you have to have an IMF program. So Bangladesh has an IMF program. On top of that, they get financing for climate purposes. It's called the RSF. Now, there are other countries in the region, in the Asia region, which are talking to us about this. But again, the point there is this is a facility which goes along with an IMF program. And the other important factor is when countries take the RSF, our money is not big, but it helps catalyze money from everybody, including other donors and the private sector. So this is a new innovation which has happened over the last couple of years. There are 11 countries around the world which have taken use of this, which have made use of this facility. The 11th one was recently Morocco.
Can commercial banks directly reach out to IMF for this program?
We don't lend to commercial banks. We lend to countries.
That's what I said, that if any refinance kind of structure can comes to big commercial banks, that will help channelize the funding quickly.
Perfect. Thank you so much all for your time today. Yes, a very short question specifically for Dr. Rupa and Dr. Sajid. How do you think the entire infra sector, specifically the green development, will pan out given the current uncertainty of demand of these energy resources? Specifically green hydrogen, there has been a lot of subsidies that are being offered by the government, but private players are quite hesitant to make a move. L&T is one of those private players, but apart from 4 or 5. Curious to get your thoughts.
It's just too specific.
I didn't get your question properly.
No problem. I'll repeat it again. Just curious to get your thoughts on how the entire green infra industry will evolve, given the uncertainty around the demand of these energy sources. So, from pricing perspective, from an international demand perspective.
How do you see green infra going forward? I mean,
actually, from L&T side, we are seeing good momentum in green infra projects. I mean, we are not seeing any major issue from the demand side. Even as a lender, we have been seeing very good, supply coming of ESG funds also. I think that's not an issue. Point is that whether this kind of its share in the total this thing is still very insignificant, because we have just made a beginning. But it's not that we are seeing zero demand for that because of the uncertainties. Actually, personally, I feel that the way central government has giving support to the capex, infra, and within that all sub-segments of infra, including the green, they have been doing pretty well. At least that is what we are seeing in our order books.
I'll just take 10 seconds to say, I'm no expert in green hydrogen, but I will say this, that for all of these things, this is one of those classic public goods where there are positive externalities. And when you have positive externalities, the private sector will necessarily, by construction, underproduce the stuff. So there is going to be a role for public policy, through taxes, through regulation, through subsidies, so that the private sector can internalize that externality. And I think that process will have to play out in the coming years. Left to its own devices, the private sector will do too little, right? And individual countries will do too little, which is why the NK Singh, Larry Summers report talks about how even at a country level, you will necessarily underproduce and you require a coordinating mechanism through multilateral development banks.
But awareness has certainly grown. So we will continue with that.
I think we are at the end of our panel discussion. I can do the job of summarizing the entire discussion over the last 90 odd minutes. Or maybe I can outsource this to the panel members. Can you just summarize your points in 30 seconds? No more than 30 seconds.
I think I think Krishna said this best, that we're in this world of unprecedented, relentless shocks, right? That we haven't seen this polycrisis world almost understates the frequency and the severity of these shocks. And I think in that environment, policymakers have to make a type 1 error, which is to build buffers every which way they can. It would be my singular takeaway.
You have to. Madan. No, he did.
So just a couple of points. One is that a lot is actually being done by the government, but the private sector needs to match it, and will match it only when the commercial considerations match their own expectations. And second is that there's a lot of uncertainty which we're living with. So therefore, any kind of conjectures for us to make on any economic variable itself is quite dicey.
Dr. Rupa.
Yeah, even if it is highly uncertain period, I think we are much better placed in terms of cushions, buffers, not just that actual cushions and buffers, but perception of investors and rest of the world about the adequacy of these cushions and buffers. And I think that will help us sell through.
Very fairly put.
Yeah.
So let me conclude by saying that I really enjoyed this event. This was truly enjoyable. Interaction with all of you was really fun. I think my takeaway is along the lines of what Sajid said. We live in a very uncertain world. Whether you call it a polycrisis or a shock upon a shock upon a shock, we need to build buffers. We also need to move away from short-termism towards thinking about the medium term. Yes, the medium-term challenges are going to be hard. Whether it's structural reforms or anything like that, it is going to be hard. But you have to start early, build consensus, and embark on these with a sense of purpose, and that's where we can build potential going forward.
Thank you. Thank you, Krishna. Hey, you have to hear my take also, please. So my take was from Thomas's presentation. India stands out as a bright spot, 6.3% growth. Actually, that growth has been hiked from the April numbers. That was my point one. My second point was from Jay's presentation, where he said, in a war, there are no winners. Sorry, that was Neville Chamberlain, but I think he made the point that in their scenario analysis, whether you do friendshoring or you do reshoring, you end up actually at a lower GDP growth trend. With that, ladies and gentlemen,
if you don't mind,
there's one more, please.
There's actually a question to the IMF. It's more of a conceptual thing. Do you all have a setup out here where you do an independent calculation of India's GDP? Or is it that you're using the official data which is provided by, this was for all countries, I'm saying. Is it an independent calculation which you'll do when you come up with a GDP estimate? Or is it based on, for example, India, the NSSO, National Statistical NSO, they bring out the data and you use that data and make your projection? Because I think there was something saying that, can we say that IMF actually supports the Indian view that we are growing at 6.3%? Or is it that you're using our own data and doing a bit of fine tuning and coming up with the same number of 6.3? Or is it an independent?
Are there any such examples where countries, people do index?
Actually, I don't know. I think this came up somewhere. So in the social media, that's why I'm raising it as to how exactly do you all do this?
No. So we take the numbers, the data from the authorities, and we have our own way of looking at it. So it is not like we have our own independent data thing and analysis thing. We look at official data, take and form our own views about consumption, investment, and so on. Some data is straightforward, which we can take, but some data we have to interpret, and take into account various factors. We talk to people like you, so it's not like we, come up with our numbers out like that. So we talk to people like that. We talk to investors, everyone, and then we form an informed decision. Thank you, ladies and gentlemen. Isha, please have a seat. I have to give you something, please.
Thank you all for a very engaging discussion. It was indeed very thought-provoking. Now, may I request Dr. Patnaik to facilitate our speakers with a small token of appreciation?
It's felicitation.
Felicitation, yes. Dr. Helbling, may I request you on the stage?
So we are an exchange, and you would have seen the well there. Whether the tie create, if you like it, only done in the morning. Yes. So try it again. Thank you. Thank you, Thomas. Thank you.
Dr. Ferris, please.
Not told to give me the twin. Thank you.
Dr. Srinivasan.
Thanks a lot. Thank you, sir.
Dr. Nitsure.
This is an NSE staff. You need to go that side. Thank you.
Shri Samnavis.
Thanks a lot. You might want to read it.
Dr. Chinoy.
Sajid, as usual, thank you so much. You might want to move the pen.
As we come to the end of today's event, it gives me immense pleasure to propose the vote of thanks on behalf of Mr. Louis Brad, please, sir. I request your presence on the stage.
I'm waiting on for it.
As we come to the end of today's event, it gives me immense pleasure to propose a vote of thanks on behalf of NSE to each and everyone whose contribution has made this event a success. First of all, we're extremely grateful to the IMF delegates for agreeing to organize this event along with us. I thank Dr. Helbling and Dr. Perez for a very insightful presentation. Thank you so much, sir. My heartfelt thanks to all panelists for graciously accepting the invitation to participate in today's discussion. Your incisive views and comments have made this discussion truly engaging and stimulating. Special thanks to Louis Brad for coming here. I thank the members of media for covering today's event. Last but not the least, I thank audience who have joined us here at NSE and online for their participation. We thank our MD and CEO, Ashish Kumar Chauhan, for gracing the event. And we truly appreciate the support and cooperation we have received from our colleagues at NSE. Special thanks to the marketing team for helping us smoothly organize the event. Once again, thank you one and all for being with us in the evening. It has been a pleasure to host you as a guest, and we look forward to your participation at future events at NSE. I request all of you to please join us in the lobby outside near the ticker room for the dinner. Thank you.
Thomas, come to Rob, come into bed. Yeah, please. Pretty man. Right, my friend. Please. Please come.